The session will be chaired by Mr. Raj Nair, Chairman, Avalon Consulting. Can I please welcome him and his fellow speakers on stage? Mr. Sanjay Kamlani, co-founder, 1991 Ventures. Shankar Narayanan, Managing Director, Carlyle Group. Mr. Ganesh, co-founder, Growth Story. Mr. Manish Kejriwal, Managing Partner, Kedaara Capital. Mr. Avnish Bajaj, Managing Director, Matrix Partners. And Mr. Vishal Tulsyan, MD of Motilal Oswal. As the speakers get settled, let me take a minute to thank our event co-host, Basis, the leading provider of fund account services, and our knowledge partner, FinSec Law Advisor. Their support along the other associate sponsors and event partners have been crucial in the organization of this event. Before the panel kicks off, Mr. Sridhar, partner of Avalon Consulting, will set up the stage for the panel with a short presentation analyzing the exit trends based on the data on Venture Intelligence Transaction Database. I now invite Mr. Sridhar on the podium.
Thank you, and good morning to everybody assembled here, including the panelist speakers. So I hope the short presentation that we are making gives you some food for thought on what's expected as far as the exit scenario is concerned over the next few years. So to start with, if you look at the investments of private equity over the last 15 odd years, from 99 onwards, there's been a total investment of about 370 odd thousand crores during this period. There are some distinct peaks and troughs that you see here. There was a cautious entry till 2003, and then 4 to 8 was the bullish outlook. Something like 140,000 crores came in between 6 and 8, which was the peak period. And then you've seen growth after the dip of 2008-9, which has happened over the last few years. So there's been a little bit of ups and downs in the last 3 or 4 years. It's been more selective depending upon the scenario year to year, and Indian economy itself in the last couple of years has been in a very different wicket. What's also interesting is to see the way the funds have been deployed, with a very large amount of the capital being raised in foreign currency. And so within each of these blocks, you've also had to deal with the Indian rupee and its depreciation. So what's stark is what's happened in the last 2.5 years, and therefore a big hurdle that investors who have come in towards 2006-07 have got to overcome when they look at exits over the next few years, or anybody who's come during the last 5 years. So we've seen a 24% depreciation in the last block of 5 years. So what's the exits itself been in the recent years? So in 2003, surprisingly, has been a better year than 2012 in terms of exits. So there's been about 13,000 crores of investment capital which has exited at a higher multiple and a slightly better IRR relative to 2012. There have been some very notable exits that I'm sure many people in this community are aware of and keeping track of. But beyond just looking at the 2-year scenario, it's important to look at the secular trend that we are seeing from 2004 onwards, where roughly about 88,000 crores of invested capital has managed exits from 2004 onwards. But what is very distinct is, what you see in the last 4 years or so, from 2010, where there's been a industry average IRR has plummeted compared to the period prior to that. And so once you look at this secular trend, what's evident is there are three distinct phases, and two which have kind of what you've seen in the past, and one which is emerging based on the data that you see of the investments which have happened. So there is the whole India shining phase, which we saw from 4 to 9. Then there was the whole melting pot phase, as we call it, initiated by the whole global meltdown, and then there's been the economic impetus which happened, and then the Indian economy shot itself in both its feet in the last 3 years. And then due to this, you're going to see a whole phase from 14 onwards where there are going to be a lot of investments which are going to be looking for a way out, which is really the theme of this whole conference. So if you look at the first phase of India shining, the total exits were about 32,000 crores of invested capital, very attractive returns. IRRs were anywhere between 30 to 60%, depending upon which year you look at it during that period. The exits were quick. Most of the exits were less than 3 years. Exits were mainly through the primary market sale or IPO. There was negligible buyback during this phase. And investments also had a very large share of pipe deals coming in, which means that they were, especially on the back of a booming stock market, they managed to get in and get out quickly on the back of the way the stock markets were performing. And IT and ITES was the flavor of the day during a large part of that phase of investment. We move to the next phase, which is 10 to 13. And exits in absolute terms have been obviously larger here. There's been 52,000 crores of invested capital which has got out, but at much lower IRRs. As you've seen, it's been 15% or lower during these years. The exits were more normative. Period being about 4 to 5 years has been the normal period of exits in any year. Predominant exits are of this nature. And exits have been mainly through secondary sale. And buyback has become more prominent because of the vagaries in the stock market that we have seen during this period. And investments have also been very fragmented. ITES was no longer the main driver of investments during this period. It witnessed a lot of volatility in line with the economic scenario. And exits were also more fragmented, with BFSI doing well, ITES losing its prime position during this period. But what's more interesting is what's expected to happen. And this is where the key highlights, and I hope that the panel throws a lot of insight on, is the fact that in this whole what we call looming logjam phase, an unprecedented 85,000 crores of invested capital of 6+ years is waiting to exit. Now that's nearly the whole 10-year exit that you have seen since 1999. And what's interesting is, if you look at the numbers, our highest year of invested capital in any year has been about 17,000 crores. So if you go by these kind of averages, this lot of capital is going to take a long time to exit. So obviously, we need to break away from the past. We need to be thinking differently as we look at the whole exits going forward. And that's really the core of what we need to be thinking about as we move forward. Now, what types of exits are you going to see? You're going to see mostly secondary exits, because the large share of this 80-odd thousand crores, which you have seen during this period, much of the inventory buildup is in non-pipe deals. And in terms of sectors, what is interesting is you have a very interesting mix of sectors. ITES is the largest, has roughly about 10,000 crores of invested capital more than 6 years. But interestingly, media has come in as one of the sectors where there's been a lot of invested capital, about 10,000 crores overall, which is more than 6 years old. And then there's a fragmentation across the other sectors. Engineering and construction, which includes infrastructure, which is where a lot of capital has also got log-jammed on the back of several infrastructure projects which have run into trouble due to various reasons, is also part of this whole mix that you see here. Now, having looked at these sectors, what's also evident is if you go by where we are in terms of the state of the economy, obviously the next 4 or 5 years are not going to be the same for all of these sectors. You're going to see ITES probably performing better on the back of the rupee depreciation, on the back of changes that have happened in the business models of some of these companies. And so that sector is likely to see a better scenario. But things like energy, media and entertainment, or even engineering goods, construction, these are all sectors that are likely to see growth rates over the next 4 or 5 years, which are, in fact, going to be lower than what you have seen in the past. There are other sectors like healthcare or BFSI, which will perform better. There are going to be challenges in these sectors as well. The whole focus of FDA becoming tougher, in my view, will actually strengthen the industry rather than harm it, because it's going to mean that Indian entrepreneurs will need to pull up their socks. But once they do that, the opportunities will actually increase going forward. So given all this that has happened, what can we take away from the kind of exits that have happened? What's evident is that in the past, we have had very successful examples of invested capital staying for more than 6-7 years and exiting in a stellar manner. So there are a number of examples here which clearly shows that just because you have stayed invested for a long time, it doesn't mean that you will not get an appropriate exit. So there are clear learnings. If you have spent this time productively in value creation, there is going to be good exits which are possible. The other part is, despite the economic scenario which have been tough in the last 2 or 3 years, you've still seen again good exits in tough economic conditions. So it's not as if you cannot find solutions to what's happened. We have had examples in the past which shows that it is possible to find solutions when you need to. But one key thing that we think will happen over the next 4 or 5 years is probably a more interventionist approach from the investors who have invested in these companies. There is a need for more active involvement in management, and we think there is a possible, if I were to call it, a 5-step approach to look at a framework to drive value enhancement and use that as a method to both to create value for the investee or the promoter, as well as to look at exiting profitably. These includes to stay focused on delivering a growth strategy, because at the end of the day, you need to, given the fact that a number of these exits are going to be secondary, you need to leave behind a growth story for the new investors coming in. So unless the company that you are looking at has a growth strategy and stays committed to that, you're going to find exits tough. There's a need to create early alignment between the promoters and the next stage investors. Again, this could be, there are lots of examples which could potentially be strategic investors coming in with the rupee depreciating. There are going to be international investors who are going to look at opportunities coming into India. There's it's important to look at governance and organization transformation. Improved governance is critical for the next stage of investors having brought in the first stage. And putting in place key personnel is a prerequisite to know that you're going to deliver on the growth strategy that has been talked about. And then the whole focus on operational efficiencies to deliver the short-term results that come out of any of these businesses. And lastly, the whole stress test that you need to do. It's a little bit like, would the existing investor himself have invested in the business under different circumstances, given the way the business is? So this critical question needs to keep being asked as you move forward. So with these words, I'll leave it to the panel to take up the various issues, and from the rich experience that they have, debate and come out with insights of what's going to happen. Thanks.
Morning, ladies and gentlemen, and Sridhar, thank you very much for that very insightful presentation. Now, we have with us on the dais 4 very, very successful investors, 2 extremely successful entrepreneurs. You can't ask for a better mix. Now, the question is, how are we going to extract what they know so that we can benefit, the audience can benefit from this? What I plan is to have each one of them speaking for about 3 to 5 minutes on this issue of the challenges for exit. And then we'll have a very interesting 40-minute panel discussion where they will explain some case studies from their portfolio. So you have live example of what issues were faced, how they were handled, and there'll be cross discussion among themselves to see how they have or did not succeed in making a win-win exit. So there are, again, lessons for us. My job is going to be a little bit like a dentist, do some tooth extraction. They know a lot, where to extract that stuff so that you have the benefit of their knowledge. We like to understand how they balance the conflicting interests and between the promoter and the investor on issues, common issues like timing of exit, valuation at the time of exit, clauses like tag and drag and so on and so forth, which probably are more important in the case of VCs than PEs, but all the same, investors have to deal with it, the promoters have to deal with it. And then there are extraordinary situations which also create problems, like when there's a mutual lack of trust, lack of transparency in what is happening around, inflated egos in some cases, and of course the classical thing about what's the best way to create value. Both are trying to create value, but they have different views. So there are issues as we go along, and the next 2 years with this, the kind of colossal amount of exits that will be desired, as Sridhar explained, the tensions can be higher unless they are managed well. I'm also going to involve the audience in the tooth extraction. Okay, it's not going to be Q&A at the end. Okay, I'll tell you what the format's going to be, but this reminds me of a story. A man and a wife rush to a dentist, and the wife says to the dentist, "Look, I'm in a hurry. Don't waste time in all this anesthesia and all this. Pull that tooth out and let us go." So the dentist looks at the wife and says, "Wow, that's a brave woman. Show me the tooth." She turns around to her husband, "Open your mouth and show him the tooth." So now we're going to have that kind of stuff happening here. In the 40-minute debate, or rather than a debate, a discussion, we'll have each one of them explaining an actual case study from their portfolio. They won't mention the name, but they'll give you enough detail so you have a good feel, much more than you have from what you read in the press. And they'll explain how they handled it, how they ended the situation, what situation they saw and how did it work out. And then they will have one of the entrepreneurs challenging them on whether there could have been a better way of doing it, better way of handling the situation. We'll have another investor also doing the same. And I'll also invite one person from the audience to ask a question or make a suggestion or whatever. We're not going to do this under anesthesia because we're in a hurry. We have only 1 hour and 30 minutes. So, all set? So we'll start with a free-flowing 3 to 5 minute opening remarks. We'll start from there. Manish, followed by Vishal and everyone else in turn. And then we'll start the more interesting part. I'm sure this is going to be interesting, but I'm saying that more interesting. Okay, thanks.
Thanks, Raj. It's great being here because I think the way Arun has organized the day, I think it just says a lot about his focus and how he's created this whole company. Because I think this is exactly the reason it's been the biggest issue. It's always been the elephant in the room about exits or the lack thereof. And I think the data that Raj, your team has pulled together is really good, and I think a lot of us don't have access, so thanks for doing that. I just want to personalize this a little bit and say why this is so critical. And I want to say one of the main reasons we started our new firm, which is a small PE shop called Kedaara Capital, was to actually tackle this head on. My co-founders of the firm, as well as myself, were in relatively enviable jobs at relatively well-known global institutions, where frankly we didn't need to worry on a day-to-day basis about our exits because our management fee more than covered all we were to worry about. I'm not saying this lightly, but I'm just saying people thought when we left our respective firms, we must be nuts to try out a new strategy. But the main reason we did that was twofold, is we felt that the type of investments happening in India at an overall level was pretty much one that you couldn't control the destiny. And it was, not to be simplistic, but not very different than going to a casino and placing a bet and waiting for an outcome. Versus being able to control the destiny. It still has to prove itself. We might fail terribly. We may not get where we want to, but at least the attempt was made to create a bit of a differentiated approach where obviously you can't disagree with the data, and we all acknowledge the issues we've had as an industry in providing returns to our investors. And the biggest reason in that, twofold. We always hide behind the excuse of the depreciating dollar, but we also hide behind the facts of a lack of exits. So the way we constructed Kedaara was truly to be able to almost think of the exit before we enter the company. And I'm just using this as an example of an approach, a potential approach still to be proven, because while we've made our first deal, we definitely have no exits to talk about. And when we get to that stage, I'll take the flexibility of using examples from our previous life. But we basically do either controlled transactions, which will be significantly more than 50% of the company that we take a stake in. Or in specific situations, we would work and have a large minority situation. Again, nothing below 15 or 20%. I don't want to put a number on the table, but I think ideally nothing less than 20% stake in the company. Very different from what the majority of us were doing from 04 to 010. And frankly, between 04 and 010 was less of an issue because most of us, if you measure our returns, it would be directly proportional to when we entered. So it was more an issue of vintage, and we all rode the beta of the market. And no matter what you invested in 03, 04, if you managed to exit it in 07, 08, 09, or even later, you typically made a good exit. And the closer to 07, 08 that you invested, barring a minority level of investments, you typically lost money. So our attempt, and I'm using that as a way to answer your question, Raj, is there are two issues. One is a significant difference of interest between yourself and the promoter, which creates the biggest challenge in creating exits. And the second, I think, which is not as often spoken, given there's a multiple number of investors in each company, you see today, even in your chart, your primary investor and your secondary investors, there's more often or not a difference of opinion or a time perspective between the different investors, which creates a lack of an opportunity to exit. So often, and we'll use that as an example later, is even though there is a good exit opportunity, the difference amongst the perspective of the different investors disallows it, because then it goes down to the lowest common denominator. And I think that is as often an issue as is the difference of opinion and perspective with the promoter. In our approach, we've kept it very simple. We wanted to have a relatively hands-on approach. We have three very strong operating partners we work closely with who are dedicated to us. One of them, we're fortunate enough to be the speaker over dinner this evening. We have Sanjay Vaga, Pramod Bhasin, and Vindi Banga. And essentially, one of these three gentlemen takes on as either the executive or non-executive chairman in the companies we invest behind. And we only go into those situations where we have a clear exit drawn out, either through a majority stake or a put. And that's the single most important thing in our function. I don't know how I'm doing on time, but it's the single most important thing we focus on. And by having a majority controlling stake, our attempt, still to be proven, I must keep repeating that, is that the majority of our investments would be to strategics when we decide to exit this thing. We are also working in two of our deals, neither of which have been done, very closely with, in each case, one other private equity firm with a very similar approach to ours. And in both these situations, when we go into another private equity firm, what we spend more time on amongst ourselves is on the governance. How are we going to decide if we have, let's assume we're going to have disagreements, how do we decide that, how do we resolve that? So while the majority of the situation we're looking at, we're going in and we would be the only investor. In two of the situations we're working on right now, we're actually collaborating with other private equity firms who we think will bring a complementary skill set. But in both situations are those guys who have a very common perspective on how we would add value and how we would exit. So I won't drag this much more. I'm sure we'll get back to specific situations and examples. But just to summarize, big points being, the fact that we left very attractive situations and managed to raise some money at probably the worst time, at least optically for Indian private equity. I actually personally believe this is the best vintage that one could dream of when everybody else is fleeing the country. I think everyone around this table are believers in the India private equity story, and I would say it seems like you're going back to the 03, 04, 05 period as a vintage. But I think this time around, we believe, and we may be wrong, that the way to do this is to remain very focused, make very select number of investments, be much more hands-on, not so much on the operations, but much more on the governance. And in our situation, at least, we will primarily do controlled transactions in which the path to exit is very clear. And at the very beginning, in each of our IC memos, we have laid out who are the three potential buyers or exits of our company. I remember 10 years ago, I think in most of our memos, we had IPO as an exit. We all know where those IPOs have ended up. I mean, some of them have been very, very successful. Ganesh, hats off to you, as we said. He's done this and provided exits a variety of times to a multiple number of his investors. And I said he's looking younger than he was 10 years ago. And when he was teasing Avnish and me that he, in his next life, wants to do a 220 model, we reminded him he currently enjoys an 880 model, so he shouldn't be worried about a 220 model. So with that, I'll end and pass this on to Vishal.
Thanks, Manish. Good morning to all. We started our firm in 2007, so we got birth when everything was going hunky-dory for India. One thought that nothing could go wrong as far as India's growth story is concerned. And every entrepreneur and every opportunity that we saw, as Manish rightly mentioned, one never really bothered about how one would exit. So everyone thought about that IPO is going to be the most viable exit option in next 3 to 4 years' time. Company will go IPO. Every Indian entrepreneur has a dream to go public at some point in time, and that's what we did. I think last 7 years of a roller coaster ride has taught most of us that even before you invest in a company, you need to do a lot more analysis about how you're going to exit that particular opportunity. Not only in the last 3-4 years, we believe going forward as well, particularly for the growth capital investors, exits through the IPO route is going to be far and few, and that's the reason why you need to really go more deep in terms of analyzing the exits. If you're not in a controlled situation, as Manish mentioned, or people who do early stage or venture where large part of ownership is with the investor community, if you are on the growth side where you typically would own between 20 and 30%, that's where we are at. It is very important that the entrepreneur plays ball with you, because if he doesn't, you will always be in a tough situation. One big negative about a private equity fund structure is your timing of entry and timing of exit is very defined. So you need to invest in over a period of 3 to 5 years and exit in the subsequent period of 3, 4, 5 years. And that's what makes your situation extremely tough. So it's extremely important that right from the beginning, within 6 months of your making the investment, you create a situation in the company or in the minds of the entrepreneur that exit has to happen in some form or the other in a 3 to 5 year period, so that the entrepreneur takes you very seriously about this particular thing. We obviously didn't do that effectively when we started investing earlier, because we thought IPO is going to be the end route. But over the last 4 to 5 years, I think we are creating that urgency in the minds of our portfolio companies about creating an exit. More importantly, we also have to look at one thing when we look at the data about the kind of investments that people have made between 2006 and 2010. Companies which have been impacted by the core GDP growth, so which could be, let's say, manufacturing or industrials or capital goods or infrastructure and construction companies, per se, these companies haven't done well. And that's where investors are going to find it difficult to exit. But where your investment strategy has been right, and you made the right kind of investments, be it financial services or consumers, and where there is a secular growth story for the next 8, 10, 15 years, I don't think investors are finding it difficult to exit even in this particular situation. We also should be mindful of the fact that somewhere the exits have been impacted by how India has performed in the last 3, 4, 5 years. The entrepreneur never thought that India is going to go through such turbulent times. Private equity investors never thought that India is going to as low as 4, 5% in terms of GDP growth. And because of that, so if you look at the performance of the Indian private equity fraternity, you need to look at it in the context of how India has done overall as against the perception that we all had. So, I think, per se, if you have the right kind of investments, there are, other than IPO, whether it is secondaries or a strategic, the exit options are going to be there. I think next 3 years are going to be challenging. I think your data talks about 85,000 crores. So effectively, you're talking about 1.5 lakh crores worth of exits that has to happen in the next 2 to 3 years. It's challenging times. Let's hope the outcome of the elections is positive for all of us, and we're able to be there, reach our goals.
So we now have a promoter's perspective.
Thanks. My name is Sanjay Kamlani. I'm the CEO of True Profile, a new startup. I've had 2 exits, Office Tiger in 2006 and Pangea 3 in 2010. Pangea 3 was a legal outsourcing company, so fits in your category of ITES companies. And we'll go in through the case study later when we talk about those. For me, I think that many of the issues around exit and the challenges around the decision about exit and whether you can achieve an exit that makes all of the constituents happy, it really focus a lot about timing. Manish, you talked a little bit about timing. I think many of the issues boil down to timing. particularly when you think about all of the constituents that are involved. Normally people are talking about the management team, the co-founders, and the investors. And the risk reward achieved within a particular period of time is what's critical for them, whether it's year 1, year 7, or some other year. But it is also important to realize the other constituents, which are the employees, the clients, and the acquirer. And when you think of what's happening at the time of exit, timing is impacting everybody. So just like the most recent investor is the one who at the time of exit is the least likely to be pleased with the risk reward, the IRR in the short time that may have passed since they invested, while the earlier investors may be very thrilled with the multiples that they're getting, the most recent one may not. You also have this problem with clients and employees. The most recent employees are the ones who are going to be the most shaken up or troubled by an exit and wondering what the future might be for them. And the clients who don't necessarily have a long-term relationship with the company and feel really ingrained with the organization may also feel that the exit makes it worrisome for them to continue being a part of the organization. And the acquirer, when they're coming in and thinking about taking over a company, what do they want? They want the employees to stay, and they want the clients to stay, particularly in services businesses like the ones I've been involved. And so the amount of time that key employees have been around, the amount of time that the key clients have been involved with the company, and the amount of time that's passed when all of the different investors have come in are all critical to whether you can actually achieve an exit that's on the table. And when we talk about the case, my experience with my last exit, you'll see that many of the issues were all about timing because, as Manish said, particularly with the investors, as I think the focus is here, the ones who came early on are looking at it from a much different perspective than the most recent investors.
Shankar, okay.
I'm Shankar Narayanan. I'm heading Carlyle's Growth Capital Group. I've been doing private equity since 1993. I got into private equity accidentally. I used to be a trader in the investment bank of Citibank, and I was to go and work for Aditya Puri as country risk manager in Taipei when he was division risk manager in Hong Kong. And so I went around and told a few people that I was going to find a wife and go to Taipei. And one of the people I told was Rajan Raheja. So he said he had money, he felt that the country was changing post Manmohan Singh's reforms, and he wanted to buy companies. So without discussing anything, compensation, nothing, I joined him as managing director of Hathway Investments, and we started doing deals in '93. The first deal we did was we bought a company, Johnson Tiles. Between Rajan and I, we didn't even know we had to do a due diligence. We bought it literally studying the balance sheet. The Bangurs, I think, were negotiating for 8-9 months. So we got the company. They probably lost a good deal because of it. I guess if we had done a diligence, we may not even have bought it because there were issues on inventory, etc. But it worked very well because we paid about 35 crores for it. We thought there was management. There wasn't any management. I ran it as CEO for about a year, then found a CEO, oversaw the business for the 6 years I was with Hathway. And all the deals we did at that time were good. We got control of Exide batteries. We did Hathway Cable, which we bought from Ashok Advani again for 30-35 crores. At a time, there were a lot of risks in the business. But we felt that since people were investing a lot of money in the channels, that there could be value in a distribution business. We were lucky because a year after we bought it for 35 crores, Rupert Murdoch paid us about 75 million for a 25% stake, and we were able to build the business with that. We again got control of Asianet Cable. We did Prism Cement. So we did a lot of deals where we had control. And what at that point of time I did is we got a lot of young guys, all of them in the 20s, who were toppers from IIM, CA rankers, etc. And we pretty much focused on a few key areas like purchasing, strategic decision, capital allocation, etc. And we essentially grew the businesses. So we bought them entirely with equity, but then put leverage and grew the business. So that phase, we were very successful. And the minority deals we did also were successful because we again chose very good partners. We did ReadyMix with RMC PLC of UK. We did asset management with Franklin Templeton. We did hotels with Oberoi's. So almost all the deals in that phase turned very successfully because it was very early days. A couple of people who did deals there where they didn't go for quality typically ran into trouble. I've been now with Carlyle for 10 years. This is my 10th year. And Carlyle is quite an amazing firm in many ways. It has got, I think, $180, $190 billion under management. We work throughout the world. We have 34 offices. And one of the key things that Carlyle has is a huge network of relationships, investee companies, etc. And that has helped us in many ways, especially in both our minority and control investments, to act as a catalyst in the transformation of the companies, because we are able to bring to bear the network of relationships, our investee companies, the network of people we know to help those investee companies. We have sold some company or the other at anything more than a 3.5x. Every year I've been with Carlyle. So we've made exits in companies like Tirumala, Cyberome, Repco, Shankar, FSS, LearningMate, Newgen, Quest. So we made various exits from time to time. I think partly because of, having been a trader, because you have to buy and sell something. Like Manish says, whenever we make an investment, we try to have, however fuzzy, an idea of what the exit would be. Because private equity capital needs an exit because from time to time, we have to exit, give money back to our investors. Over a period of time, because I've been doing it for so long, I've kind of honed what, the investment philosophy should be, what could be a potential thing. Probably early in the career, I spent probably a lot of time on a balance sheet analysis, doing various scenarios. In India, I would broadly cut into it because in growth capital in Carlyle, there have been a couple of cases where we have been in control. Cyberome, which is a network security company, we own 80%. Eliteco Technologies, which does BSS, OSS BSS software, we had about 80%. Newgen, we had about 67%. LearningMate, about 80%. So we have done deals where we were in control. And we have done deals where we have been significant minority. Now, in the minority deals especially, I think it becomes very, very, I judge deals essentially on two criterions. One is we look in the entrepreneur, drive, hunger for success. Eventually, if a person likes a laid-back kind of life, difficult for you to make money with him. He can be a friend. If he goes plays golf in the afternoon, he probably won't make too much money for you because eventually in a minority situation, the PE guy is trying to go to heaven without dying. So, there is no one to die for you. It becomes very difficult. So you need a guy who's very, very driven. The second point is integrity. I think increasingly in India, I think it is good business practice to partner someone who follows all laws. It is difficult. India has changed over the last 20 years. But if a person doesn't have integrity, he may not treat you fairly, and that becomes a very, very big issue. So these are the two essential attributes we look at. We also like to align our interests with the entrepreneur, because if interests are not aligned with the entrepreneur, it becomes very difficult. Because in a minority investing situation, more than anything else, you're not backing a company, you're not backing a business, you're not backing an industry, you're backing the entrepreneur. And, if at the end of the day, your interests are not aligned. So, there are a lot of entrepreneurs who come and say, look, I have this business, and I'm keeping this business which is making losses outside it. And that becomes very, very problematic because even if the guy's intentions are good, how much time does he spend on the loss-making business? At times you'll invest in the good business and then suddenly find afterwards the good business has become the bad business and the bad business good business. So it becomes very, very important that interests are aligned very much with people. The other thing is valuation. I think what has happened since I started in 93, see, the classical private equity theory is, private companies are cheaper than public companies. I think India is one of the few markets where, every deal I've seen probably in the last 10 years, you have valuations, people's expectations of valuations very high. If you don't keep discipline in valuations, even in a good business, the chance that you'll make good money is low. Like I was recently telling a banker, the typical problem in India is, most people buy an egg for the price of a chicken. And then, what happens? If the egg becomes a chicken, probably you get your money back. If it dies along the way, you have a problem. And if you see the deals in India where people have trouble exiting, where people have ended up losing money, it is essentially because of two things. One, lack of integrity. Two, people paying way too much over what the right price is. So I think India, there is a lot of potential in terms of entrepreneurs from middle class, lower middle class families who come out of nowhere, build great business. So if you go in as a partner in a proper structure with people with the right attitude, right approach, high level of drive and integrity, I still think this is a place where you can make a lot of money. Thank you.
And now a promoter whom a lot of private equity would like to invest in.
Yeah, thanks Raj for the kind words. Thanks Arun and Venkat for the opportunity. Before I start, a couple of caveats and disclaimers. One is that, like they say in mutual funds and all that, past performance is not indicative of future. Okay, right? So that's one. And two, when I talk, if some of the things seems to be too good to be true, it is actually too good to be true. I'm an MBA, as are most of the people here. As MBAs, what we do is we do something. If it doesn't work, we blame it on the government, the environment, the dollar, and now the Aam Aadmi Party. And if it works, then we make charts, presentations like the ones that you saw, and bar charts and graphs, and say that this is all because that's the way we planned it. Okay, right? So genuinely take it with a pinch of salt. If you want to know where to buy the pinch of salt, it will greatly help my exit if you buy it from bigbasket.com. That's one of the top e-grocery, the top e-grocery company that I promoted and I founded. So that's available. Now Arun will give you a discount on the bucket of salt that you want to buy. But seriously, with my false attempt at modesty, I'm going to blow my trumpet. Okay, right? So last 2 decades, I've been doing started companies, all of them greenfield. I know less about private equity, more about venture capital side of the early stage side of the business. The first one, 20 years back, we started. So my own journey has been in 2 decades. The first decades, in 1990, there was no concept of venture capitalists. There was no risk capital. We never thought about exits or valuations or raising private equity money. So that was a great experience. It was a startup called IT&T, which is now part of iGate Technology Solutions. iGate acquired it after about 8 years. And like all entrepreneurs in 1990, we just started. The whole idea was not about exit. The whole idea was how to meet your monthly bills of salary and purchases at the end of the month. So the happiness was not about valuation, exit. Happiness was positive cash flow. End of the month, if you had paid off all your dues and your employees had been paid off, that's great. Okay, right? And it went on very well, but there's a problem with that. That's why this conference is very topical. If you don't know where you're going, like they say, any road will take you there. So we ended up running the company extremely well, growing very fast, but we did not plan for the exit. We did not know what the end state is going to be. We didn't have it as a bootstrapped company. Lot of passion, very good market demand, high growth, but just no exit. Okay, right? We had an accidental exit. iGate purchased it, so that was fine. But the key learning really was you need to, even though you are passionate as an entrepreneur, you build a great company, it's your blood, sweat, and tears, all of that goes in. You have to plan for an exit. Yeah, if you don't plan for an exit, you will not do the right thing. So that is a great learning. How we did that, we talk about in the second part of the second part of the story. My next company, this was in 2000. We started Customer Asset, which is today one of the top listed as First Source Solutions, part of the Goenka Group now. That is a company that we started, and incidentally, it was people like Manish in his earlier avatar as McKinsey consultant, and Neeraj Bhargav wrote the NASSCOM McKinsey report. One day I was reading the report, how India is going to become the BPO capital, and then said, this is the opportunity, so I'm going to jump into it, okay, right? That's how it started. So in case any of you feel that the McKinsey and the consultants and the graphs and the presentation don't help, they actually do help, okay, right? So that was genesis of the company. We raised venture capital money. That taught me a different part about the exit, because this is the time in 2000 we started. .com boom was happening. Suddenly within a year, .com bust happened, the whole thing collapsed. Then September 11 happened. So really the shit hit the roof, okay, right? We didn't, but fortunately we had raised some money, but 2 of our 3 investors had already exited. Exited means they exited the business, exited the country. They didn't have anybody there. We had only part-time directors. We had only part-time directors in our business who are not even employees of our investors. Now that was an extremely tough time. Add to that September 11. So we had to really find an exit, not because investor needed it or I needed it, but because the model was under serious stress. We are fortunate to get ICICI to buy us out. It became ICICI OneSource and listed as First Source. We got a good exit. I would not call it a great exit, but it's a good exit. People got money, multiples money, founders made money, and we did that. But more importantly, we got an exit. When you're in trouble, any exit is good, okay, right? But this is a positive. This is a positive exit that is there. So that really taught a lot about time frame, because one of the things that I disagree with what was said earlier is people who come in later may have a different perspective. People who come in earlier may have different perspective as investors, but it varies. We had a situation where our last investor had come in 4 months before the potential exit. He had no interest in exiting, but he also got the highest IRR because he said, I don't want to exit. So we had to pony up higher amount of money for him than whatever was agreed. The early investors, earlier 2 investors, they had exited the business, exited the country. They were happy to get any exit. So we had to do readjustment. So how do you align various different investors in that exit was a great learning. Incidentally, this was in 2000. I also had in 2003 one of my friends. I don't want to name the company for obvious reasons. He started a BPO company out of Bangalore and got investors, more like a high net worth angel investors into the business in 2003 and 4. Okay, right? I met him last year, about 8 years. He says, what's happening to your company? He says, we have shrunk the company and we have moved to a smaller office. I said, man, it's 8 years. Don't you want to give exit to your investors? He said, listen, 3 out of the 4 investors I had are actually in deep trouble. They've been convicted for fraud and they are in jail. So the kind of exit that they're looking at is a different kind of exit, okay, right? Than really what I want to give them. So exit from my company is the least of the problems. The company is still running. I'm sure you guys know who the people could be, but that's on a lighter note. So that really was a great example in terms of how to align people to that, okay, right? I think the business models for exits obviously are different. We are trying to create that. The third company was a company called Marketix, which is in high-end data analytics. Of course, Raj knows the people. Marketix is a great example. We started it in 2003, I and 3 other founders. We started it from rented computers, rented offices. We wanted to raise money. VC said this business model will not exit. This is days before of big data and music. This is high-end analytic niche business, very nice business, will give you positive dividend, will give you profits, but will never be able to exit. We were never able to raise money because they said they will not exit. It cannot exit. So we put $500,000, 2 crore at that time from our business, bootstrapped the business. It exited in 5 years for $63.5 million, okay, right? Just 4 of us, no VCs. So in case if you're not able to answer the question, what can the exit be? One of the answers is don't take VC or PE money, just do it on our own. That obviously, $500,000 giving $63.5 million in 4 to 5 year time frame is perhaps the best of the exits. My last one was Tutor Vista. In our presentation, some numbers were shared. The numbers are not really correct. We had a very good exit. And there the story, the learning was, how do you get a strategic investor early on to the game, which can build value in the company, but at the same time does not affect your exit potential. We had Pearson, which is the world's largest education company, takes 17% stake as a part of Series C. Okay, right? Now that is like a kiss of death, okay, right? This is the largest company. It can give you a lot of business, but if 40% of your business is going to come from Pearson, then Pearson's competitor are not going to buy you. 40% didn't come from Pearson, but so we gave 17% to a strategic investor first, then we sold eventually to them. So that is a great learning on how do you get exit despite having a strategic investor early in the game, and what all can you do and do that. Again, this we will discuss in the second part.
Thank you.
Fantastic story, Ganesh. Thanks, Raj, and thanks, Arun. So just quick recap of my own background and my association with investing and exits. Started off as an entrepreneur, so I've seen both sides. So came to India in 1999, started Bazi.com, got 9 investors with various all colors of VCs, sold to eBay in 2004. Started angel investing at that time, was lucky enough to get into Sanjay's company right at the outset, got into companies like ClearTrip as a founding investor. So good ride, probably 15 investments as an angel investor, and maybe another, since then started Matrix Partners India, and maybe another 30, 35 more as an institutional investor. In terms of exits, right now it doesn't look that rosy, but I think if I look back and keep it all in perspective, I've had between personally and institutionally 6 exits, out of which 2 are IPO, 4 are strategic sale. And something that we probably don't discuss enough, and we should at some point in this panel, is there are probably 4 I could exit today if I wanted to. I don't want to. They are compounding value very fast. So I don't want to exit them, but if I wanted to, I could have exited them. So I think it's been overall a decent run, but are there plenty of situations that I would want to exit today, or we would want to exit today and we cannot? Absolutely, and we'll talk a little bit more about that. But to step back, I think as Vishal mentioned and then Shankar mentioned, one topic we are actually not talking about today is exits which are largely entry mistakes, which companies should not have been invested in. Very sobering statistics, 85,000 crores looking for an exit. Let me put it at a little bit more perspective. That's about $15 billion. Typically that $15 billion on average, given the stages, may own 10 to 15% of a company. If we would like to generate for our investors a 3x on that, we need $45 billion to come out. With that ownership, we have to create $400 to $500 billion of value for us to generate a 3x. That's not going to happen. It's just not going to happen. So the starting point is wrong, because India's market cap today is 800 billion to a trillion. So first of all, take the 85,000 and say 70% was wrong. That's the starting point. And I don't think people have actually reconciled to that starting point. And I think they're lying to their investors if they haven't. So lots of markdowns, lots of write-offs, because these were investments that shouldn't have been made. So I think that's one thing we are not going to talk about, because that's probably a conference on how to invest better, and to some extent what Shankar was talking about. What do you look for in a good investment? The other thing we are not going to talk about as much is you cannot control sentiment. So some of the exit problems are currently, and I agree with Ganesh, and actually Sanjay also mentioned this, I don't find exit problems on the venture side. Actually, the exit problems are more on the early growth side, which are more related to macroeconomy. Also they are sectorally different. Infrastructure has more problems, manufacturing, but others don't. But you can't control sentiment. There are exit windows when they come, and I believe a bubble will happen in India. Just be ready. Just make sure your companies are ready to time that, and it may happen through, well, depending on the election results. As people were joking, I have a different exit strategy. If the election results are in a different direction, I am exiting the country. But that's also a topic one cannot control. So I think one cannot control sentiment. As investors, everyone talks about there are fear cycles, there are greed cycles, and when they are in the middle of the fear cycle, they don't recognize they are in the middle of a fear cycle. When they are in the middle of a greed cycle, they don't recognize they are in the middle of a greed cycle. We are in the middle of a fear cycle. This is the time to buy. A greed cycle will come. So I think keeping that perspective also helps. Like I said, there are elements one cannot control. If the country becomes a banana republic, I think all of this is irrelevant anyway, right? So I think that's the second topic that one cannot control. I think the real crux of the issue is situations where there is modest value creation. How do you convert that into value realization? That's the exit problem in India. Situations where you have made a wrong investment, you shouldn't have made it. Situations where you have a runner, it's doing very well, you will get an exit. Like I said, there are situations in our portfolio where it's a permanent exit opportunity. I could go sell that anytime. It's the middle outcomes. It's the 1.5x to 3x potentially, maybe even 1x, just getting your capital out. I think those are the real exit problems. And my personal experience, and I think we will get into this, everybody has mentioned promoter incentive alignment, and we operate in that. Our median ownership in Fund 2 is about 35%, in Fund 1 is about 25%. So we operate in that area where our destiny is controlled by the entrepreneur. I think Shankar had great points on what kinds of entrepreneurs to pick there. But I also believe what we don't talk enough about in terms of incentive alignment is the soft incentive alignment. How much India is all about relationships. The promoter, there may be a 5x value creation in the business. The promoter decides, irrespective of legal agreements, what is the value realization you are going to get. You could do all integrity checks, but there would be money going out one way or the other, right? So I think getting that soft incentive alignment, the moral commitment, the bonding over a tea and a coffee, board meetings are irrelevant in this country. I think those things are very critical, and that's what we have found as one of the most important tools. With that, I'll give it back.
Thank you, everyone. This is like, waiting in the dentist's reception. So everybody's brave. They talk about our happy things. And just about time for entry into the room. We'll have a little more grim discussion, and you saw that just now. Now we're going to have the tooth extraction. We've got 4 investors. No one's going to believe in this audience that everything was hunky-dory, and you had great exits, and you had fantastic stories. Surely there have been a few cases where it was really, really rough. I'd like you to pick up one, explain in honesty and all detail, without mentioning the name, what the issues were, how you handled it, and then we're going to have an entrepreneur challenging you and saying there could have been a better way to do it, or whatever, or maybe he agrees with you. So let's start with Shankar. Let's have a case where you had a real rough time, in spite of Carlyle being so good at spotting the right entrepreneur and the right company, proper due diligence, yet things go wrong.
Hello. Yeah. See, partly because I've run companies as a CEO, I think one of the things we do, we take great amount of caution and
No, I'm not going to give you the luxury of doing all that.
No, I'll tell you.
Please come to the specific company and tell us more about the company, because we've got just 3 minutes. No anesthesia.
I have to give you a little bit of background, but I'll tell you, I'll answer your question. But see, one of the problems in India, most people in PE are very, very bright kids. And once you sign an agreement and get into that relationship, in a lot of cases, people tend to give their opinion on everything. So one of the things we do as a group, we generally try and keep our mouth shut initially. We have one issue, which is our economic interest. So we never open our mouth until it comes to that. So we always defer to the promoter. And I always say with the promoter, you have to win credibility. If you demand credibility on the basis of an agreement that you have signed, it becomes a problem. When I ran Johnson Tiles, Raja was the owner. I would hate it if someone came and told me 3 times in a day what to do. And in a lot of PE, VC-backed firms, the promoter thinks the VC or PE guy is running it, the PE guy thinks the promoter is running it, and it becomes a mess. So a lot of cases, that becomes a problem. In Carlyle per se, we haven't had much of an issue, partly because of it. But I have had issues in my past avatar So in 21 years, probably the first deal on which I lose money is one of the investments in Carlyle. But when I was in Hathaway, we had one or two messes. One mess involved, same approach. We were 50-50, and then we discovered that the 50% money that we put to get our 50%, all the money was siphoned out. So then on top of it, we lent him 10 additional crores by standing as a guarantee for something. So we gave him the 10 additional crores. But as part of that, we took a pledge of literally everything. And then when we were very clear that, look, there's no way this guy's money was coming back, we threw everything, including the kitchen sink at him. So in India, while people think litigation never reaches a solution, litigation becomes a very, very important tool to settle the dispute. So in that case, we got 100% of the control of that company, literally by paying. We got the balance 50 for nothing because the guy had siphoned the money out. We settled the deal, and eventually we made a lot of money on a small investment. The second case was equally interesting. We had a situation where 50-50, we had 5 nominees of ours were on the board and 5 from the other side. And so this is one of the things where the MD was to be their nominee. Fine. And then the guy comes to me and tells me, look, my father-in-law is very well regarded. Why don't you make him chairman? So, then it becomes very difficult. So I told, okay, let your father-in-law be the chairman. Anyway, he was a nice guy. So my guys got along with the guy who was the MD. Then one fine day, the promoter tells me that, look, I don't like this guy. We got to fire him. So my colleagues, one of them was stationed at that place. He told me, look, it'll be a big mistake to fire this guy. So I told him, look, at the end of the day, the guy who owns the shares and a partner is the guy whose nominee it is. He wants to fire the guy. Okay, let's fire the guy. So then they got a retired government guy who was initially hostile to us. So at that stage, I had to decide whether we let him become MD or not. I said fine because I thought the guy had some kind of sense of proprietary integrity. He became the MD. And then over a period of time, he warmed up to us. So normally, my colleagues used to go for the board meeting, and I also used to be there. So for that board meeting, only I turned up. Of all the 5 guys, only I turned up. So as soon as they land, this guy says, look, I want this MD out as well. So then I told him that, look, this is a problem because, unless you think the guy has an integrity issue or he's incompetent, you've given him a 5-year term. The last guy you wanted out, we agreed. Now you're telling without any reason you want the guy out. So then I realized he was adamant about it. So then, there was a clause in our agreement that if none of us were present, there was in quorum for the meeting. So I basically left the place. So the next time I went with 5 guys. His 5 guys were there. Now, one of his 5 guys was the MD. So then what happened was I told that guy to recuse himself. So they became 4, we were 5. But then we passed 2 sets of resolutions. It became a big mess. We eventually litigated it. But as part of the litigation, what happened was the other party, they were uncle and nephew. There were 2 people in it. And eventually I realized that there was some dissonance between the uncle and nephew, and we eventually settled it. We got 100% control. But litigation helped us to settle it. So that is what happens. The other thing is, in all these situations that we have had, in Johnson Tiles, again, we had litigation, which is a separate story. It is very, very important that you don't lose the moral high ground. So all these people with whom I've litigated, like Johnson UK in the case of Johnson litigation, in the other case, I was always friendly with them. I always told them what it was, and I always told them very clearly why I was fighting them. So it becomes very, very important that you don't let it degenerate completely at a personal level.
So basically you're saying don't extract my tooth. You're not telling us something really, really tough. Okay? Where you really had a tough battle and you lost money?
No, there is nothing like that, unfortunately.
Okay, then we'll move on to Vishal. Let's have a difficult situation.
So, cases where the business has gone completely wrong and there's no way you can't do anything about it. The entrepreneur himself has lost money along with you. let's not talk about those cases. So there's been one specific case. See, as I said in my earlier, one of the negatives for a private equity fund is that your timing of exit has to be defined. You need to exit the investment within a period of 5 to 6 years. And probably at times, the promoter, particularly if you're doing growth capital, could take advantage of that because he would know that you are running out of time, and that's why he might like to extract more from you. So there was one specific case. We were a minority investor, and at some point in time, we were supposed to take the company public, but because of the situation, one thought, why not do a strategic? This would have helped us get an exit, help promoter get some cash out of the business, and company could also get additional cash, which could help the company. The company was doing very well, and that's where promoters saw an opportunity, and he said, I'm letting go of my company, and in a situation like this, what extra you can give me, and only then we'll do a transaction. So that was kind of a tricky situation. We said, we've been together with you all along. I own X percentage in your company. Whatever be the value we get, I get X percentage of that. And that probably, and he said, we will probably do the transaction only when we come to an agreement on something like this. But I think at the end of the day, then you sit back and you look at it from the other guy's point of view as well. That yes, he is today owning 60% or 70% in the company, and one of the reasons for him to do the strategic is also to give you an exit, and in the process, he will let go of the control of the transaction. So, he can come around and say that, I am right in saying that I should get a higher proportion of the valuation. So it was a tricky situation, and so somewhere at that point in time, I think as a fund, you really need to look at it if you are meeting your overall objective in terms of your IRR in multiple and how much you are letting go of to do an exit. But ideally, you would not like to be in a situation like this.
Ganesh, what do you think is your perspective on this particular case?
No, I think, so specifically one question, there obviously are drag-along clauses that applies to the investor to be able to drag the entrepreneur along. Normally, if it's properly negotiated and it's not a distress situation, the entrepreneur said you can drag along after 4 years or 5 years. So I don't know if the situation was after a 5-year period. If it's earlier, if it's in the early period, say after 2 years and not the 4 or 5 year horizon is not done, then I think it's fair for the entrepreneur to say that it's too early, you want to exit, you are getting it, therefore I need to be topped up a bit. How much is it is something that you can discuss. But obviously if it's beyond a period, because once that period is over, the entrepreneur is under pressure to give you an exit, right? So I think a lot would depend on that. In my 4 exits in the companies that I've been a founder and promoter, on one occasion I had gone and topped up the investor. Like I mentioned, this is a case in customer asset where the investor had come in just 4 or 5 months before the exit, and he was being adamant, and he was trying to negotiate from his fund point of view. So I took out money from my pocket and gave it to him, even though agreement-wise I didn't have to give it, just to sweeten the deal. Okay, right? So again, you've done it from the reverse end of it. Okay, right? But I think one perspective, Raj, I'd like to say is, I think we keep talking about investor here. From the entrepreneur, while it is right to say that in case of private equity, a lot of money comes in, the investors are siphoned off money, integrity, all that is fine. What about the other side? What about the contribution, value addition, governance from an investor perspective? I have seen a lot of cases, I mean, not from this panel or investors in this panel, okay, right? Where investor is being short-sighted. He does not, for him, it is one of the portfolio companies, okay, right? They are looking at the entire fund return, okay, right? And like it always happens, people never talk about when you got out for duck. People will talk about when you made a century, okay, right? People will talk about all their successes. But for the entrepreneur, it's completely different. It's not a portfolio. For him, it is 100%. Even though I'm a serial entrepreneur, for every time it's my passion, my 100%. My skin is in the game for a far different level. Then you have an investor for whom A, it's a portfolio. 2, he gets 2%, 3% management fee, 20% carry, and he's sitting in lovely offices. You see offices of any of the investors. Okay, it's a lot more this, okay, right? And you look at the dress and look at the amount of hair. These guys look so smart and so handsome and debonair. I mean, look at Avnish and look at Manish, okay, right? And look at me, okay, right? Okay, right? And this is what an entrepreneur is. Okay, right? Okay, right? Yeah. Oh, you do have a big okay, right? No, but you know, before I started this entrepreneurship business, I was as handsome and more debonair and glamorous than these guys. Okay, right? This is what 4 entrepreneurship and 4 exits. No, so on a serious note.
Barber shop in the morning.
Okay, right? Yeah. No, on a serious note. Harvard or IIM spreadsheet, sitting in a lot of ivory towers, an analyst from these guys are good. The partners are good because they also have gone and raised money on their credibility, so they're good. But many times I have seen people down the line, young Harvard MBA types, come in with spreadsheet analysis. They are sitting because they have got 20%, 30% stake and analyzing and commenting on the business, whereas the other guy has given his blood, sweat. He's 100% in, man. He's not in. So I think we should talk about there's a huge amount of disservice has been done to the entrepreneur by the investors by not understanding, being under a pressure of exit, trying to do that. Again, not specifically referring to these investors, not anything. I think that's important. So that is where it comes in. That alignment is important. For every one case of somebody siphoning off money, I can quote more than one case of investors screwing up the happiness of the company and actually being detrimental to the company. Okay, right? I have been fortunate. I have raised money and given exits to 9 different venture capitalists in the ventures. Marketex, we didn't raise any money, 9. Out of that, 8 of them was a great experience. 1 was a very bad experience, but because eventually the exits were all there, successful exit, good, it didn't really matter. And the same investors I go back and work with again and again. Okay, right? When I raise money for the latest venture, I raise money from people I have worked with before. They come to me, I go to them, and all that stuff. I'll go to 8 of the 9. I will not go to the 9th. I will not go to the 9th. So there is a lot about trust. I think Avnish mentioned it. There is a lot about understanding and looking the entrepreneur and the investor at the eye. From the entrepreneur's point of view, treat the investor as a co-founder, as a partner, as your wife, as a spouse, not just as an investor. If you do that, everything else will get settled. Okay, right? They are be as transparent to it.
One of the things we are good at doing is, at the end of the day, the company is the entrepreneur's life's work. You know, like he rightly said, you know, for the private equity guy, it is one of the many companies. And you should respect it. You should respect the passion and commitment the guy gets into it. Then the relationship works. In every exit that we have had, you know, when the entrepreneur realizes, look, having got Carlyle in, you know, he has gained, he's better off from it, then the exit becomes very smooth. I do not know of any single drag that has been implemented successfully when the entrepreneur doesn't want to do it. It is virtually impossible to do that. So it is very, very important we do it. And the other thing, if you notice, you know, each of the 8, 9 exits I listed, every exit I've made in Carlyle, the guy who bought it from us is better off than the price he paid us. You know, that also becomes very important. You know, when you're illogical, you try to completely maximize it, then it becomes difficult. Each and every one of the exits I've done in Carlyle, the investors who brought it from us is better off.
So Ganesh is saying that the 2020 vision of the entrepreneur should not be blocked by the 220 vision of the investor. So Manish, can you tell us a war story?
Happy to. This would not be a tooth extraction, it would be a root canal.
Okay.
So we'll make it as graphic as possible, if that's what you wanted. It's easy to look back at these things now in retrospect and explain them, describe them. I can tell you the emotions at that time were very different, right? But I think the first thing I want to start off with is a bit to what Ganesh and Shankar were saying, that many of us in private equity believe that, at least in the Indian context, and especially look at the sort of investments we made at Temasek with the larger families, we would rather not get litigious Firstly, if you go litigious, there's a 10-year period. The outcome is unknown. So essentially, while we bake in all the rights in all our agreements, if the outcome is not where you expect it to be, it's very difficult to extract value from your agreements. In a sense, we all negotiate really hard. I think the lawyers make the most money on those agreements, and then frankly, they're lost somewhere. And we try to pull out what the tag or the drag or whatever, and there's a difference of opinion. More than Aki Sharam, there's nothing else you can really go to from a promoter perspective, right? But I would say in the majority of your cases, and now I can see these numbers because we used our past deals to go and raise money. And we had, and I'm saying about 27 deals that we've done in the last 10 years. And I'm looking at my combined Temasek history and my co-founder's GA history. Of the 27, there were about 19 were Temasek, 8 were GA. I'd say in 25 of those 27 cases, the promoters were absolutely honorable. Majority of them we had exits, good, bad, it's a mixture of performances. But I'll tell you, the root canal is in those two situations where the promoters or the entrepreneurs, promoters in our case, well actually one promoter, one entrepreneur, were not honorable. And in our business, it's about people, people, people. And I think I would not blame the entrepreneur, we'd blame the private equity firms. If you are backing people who you couldn't trust, shame on us for doing that, and there will be a couple of people who will come that way. I'll give you a bit more color on both these situations. One was a Temasek situation, one was a GA situation. We've actually, in most of our discussion with the LPs, frankly, these are the two you wanted to not discuss, but these are the two you ended up discussing most often. Because the numbers showed out. One was a write-off, the other was low negative returns. And often the learning, in retrospect, the learnings from those were far more powerful. And actually it made great stories and discussions with the LPs. So my other thing is, anyone raising a fund, don't hide your mistakes. Actually speak a lot about them. Especially if there's time as in here, and it's a long time ago, you can actually be rational and logical about it. The common themes across both these investments: one, multiple investors. In both these cases, we had 4 or more investors in the situation. Number two, in both cases, we backed a person or a group of people who were reputed to be amongst the best in the relevant industry, but we didn't know those individuals personally. A wife or a husband or a spouse or whatever Ganesh said about an investor, I think these are your best friends or your worst friends. And for us, the softer side that we were talking about and due to the hard side, a promoter or the investor will make the toughest decisions if there is a personal rapport and you're doing something which is right. I mean, in all of us, there's a humanity. You will not do something wrong, unless you're born a certain way. So, multiple investors, and in both cases, a team who was regarded on their CVs, call it an MBA from the right places, call it whatever else. You couldn't get better. But we didn't know the people. In both these cases, and then in one of them, and one I'll describe in a bit more detail, there was an option. This was in the heyday. Investments were both made around 2005, 04, 05. In one of them, in 07, we had a superb exit option to a strategic, where it would have been, instead of a write-off, it would have been a 3.5x. Gets back to Avnish's point about fear and greed. You've got to know at that time we were in a period of greed. We did not exit. So if I combine these two examples, the messages to me were: one, don't deploy capital in people you don't know, no matter how good the thing is. Number two, differing perspectives on investors will have different agendas, different egos, and different end results. Third, the worst one because you saw an exit 2 years ago. Be very aware. Are you in a period of greed? Are you in a period of fear? And in a period of greed, you have whatever differences you have with either the promoter or your other co-investors is exaggerated even more, because you might have a situation where a certain fund has done well in which he might want to exit. You might have another fund where 8 of his other investments have gone to the dogs, and this one is the one he wants to hit out of the ballpark. So there will be an incentive to stay. So it's just multiple things playing within your situations. And the final one I think is important, and here we'll put the thing in our feet. We'll shoot ourselves here. In both these situations, the 2 examples, luckily for us, were probably the smallest dollar invested that we made. So I go back to Ganesh's point. In both the situations, because there were multiple investors, there were too many cooks around the table, and it was a relatively small investment compared to the 25 other investments we made. Frankly, as investors, we did not have the right amount of oversight, and frankly, we probably did not add the value that we should have added under normal circumstances. So very important, I think, for the entrepreneur or the promoter to realize, hey, is this something that the investor is doing and he's totally committed to and will spend the time? Or, like in these cases, partly both people's fault, but we frankly ignored it. And you will see in any private equity firm, Ganesh is right, it's not just the external world, the internal world. You'll always want to spend more time on those companies in the portfolio which are doing well, and you'll naturally spend less time on the portfolio, which actually what's required is the opposite. So there's a tendency to self-select and go with the easier lifestyle ones. So, by laying out this example, I'd say, the memory is tough, but I would say it's never clear whose fault it is. But at the end, if you can't get to a resolution, then you're going to have both sides suffer.
Now, Sanjay and Avnish, you're entrepreneur turned investors now. I'd like you to look at these 3 cases which you heard and see whether things could have been done differently by, let's say, going through some of the steps in advance which Sridhar talked about.
So
These are 5 steps he talked about in his presentation.
Yeah, sure. So, I think you talk about, people that are, not honorable and siphoning off money and doing related party transactions, etc. And as an angel investor, I've certainly seen a number of cases where the companies are, even before the investment is being made, we see instances of someone renting from their father and employing their cousin or whatever. I think you're better off not engaging in those transactions at all. I mean,
But having gotten there, what do you do?
Sorry?
Having gotten there, what do you do?
I think that you have to be strict very early on about reporting related party transactions, about reporting. So something else that I've seen as an angel investor, the reporting that I've seen coming out of the angel companies isn't anything like what my companies have done or what I typically see in the U.S. And it sets a framework for what happens later on if the seed investors and the next round investors keep saying it's okay to not have good reporting because you can't afford it. So one thing that happens, I think, more in India than outside, much less money is put on early on. Another thing that I've seen happen is that even though we agree to put money into the company, we say, we'll do it in tranches. And that constrains the entrepreneurs from doing what they really should do or what they need to do. And often one of the things they don't do is hire a head of finance. And so the reporting is negligible. You can't see what's happening. You're not going to know whether they're engaging honorably or whether there are related party transactions, and there's no finance guy to step up and say that these are the issues. So I think that's a big focus.
Avnish,
So I'll come to your framework just to add one thing, basis I think similar root canal stories as Manish mentioned. You know, often in investment, and I think again somewhat similar to what Shankar was saying, often in investments we are evaluating promoters for capability. Often we are evaluating them for our view of their integrity. And the framework that we have evolved to in our firm is, that's the floor. If somebody is below the floor, you know, we're not going to invest. I think that everybody does. We've also got the concept of a ceiling. If a promoter, there are highly capable guys, but they show up during the course of your interactions with them, enough erratic behaviors, enough red flags, that if things are not going well, so these are not guys, so I think these are the guys when a fork comes in the road, and they can take a right and create value for themselves, or take a left and create value for you, and if the situation is not, it's a little bit of a zero sum, they'll make a right. And I think that is what we have tried to figure out in our firm, to spot those up front. And where we see those red flags, just stay out of those situations. Coming to this, I think in cases of those root canals, I actually believe it's a carrot and stick approach. There is the sit down, and one of my guys puts it well, and I don't even remember all the words of this Hindi saying. It's Sam, Kam, Dand, Bhed, or something like that. And that's his approach to managing these to these guys, and which is, you know, we sit down, we have the aankh ki sharam, I have had meetings with the promoters and I've said, tell me your intent. What is your intent? This is the agreement. What is your intent? Say intent is noble, okay. Next thing you find out, you've set up a follow-up meeting a month later, the assistant keeps pushing that meeting out. You know the intent. The intent is not honorable, right? And I think we have then the done piece of it, where a letter goes out saying, as per our agreement, we have to trigger this. And maybe not go all the way to litigation. And actually, to Shankar's point, I've probably never sent a letter, because most Indian promoters would consider that a slap on their face. But probably sit down and say, be firm but not be rude, and say, I have to do this. It is not personal.
But you should write letters, in the sense, in some of the messes we were very good at writing letters. We would write a letter literally every day. So when you go for litigation, God forbid a judge sees it, he really sees the track record. You know, there are 3 or 4 cases where we've been able to use litigation. Contrary to what people think, you should use litigation as a last resort, but it's a very, very powerful tool.
Yeah,
and it will always result in a settlement. But there are no guarantees. And the classic case is a company where, for various reasons, we got control of 51%. So the promoter went to 0. And he argued in one of the high courts, so what if I have 0? I have a right to run this company. And the high court agreed with him. You know, so you would normally think, you know, the guy has 0 shares, you know, what locus standi he has. The high court agreed with him. He went to the Supreme Court, and it eventually got settled in a technical manner. You know, so anything can happen.
No, but, you know, in some ways, this piece of it, again, and this is the reverse of what I was saying earlier in terms of soft, but I think this is the yin and the yang. It is a tool to bring people to the table. That's how they come to the table. Beyond a point, you know, I keep telling people, begging is not an exit strategy, right? Yeah. There has to be some firmness about it.
We had a minority investment where, you know, after 5 years, you know, the banker who did the deal originally comes to us, tells us, look, the stock market index was X when you made the investment. Today it is 40% less. So you take 40% less money and then go away. So we started writing letters to him. Actually, the late Anand Bhatt was a lawyer on that. We used to write a letter every day and tell him that, look, you took this money saying that you would do this project. Instead, you took this money and did everything else under the sun. So then out of the blue, our lawyer was Kanga. Bhakta called me up and told Shankar, kya karna hai? And he's a very prominent industrialist, so you won't think he would do that. So the banker first called me. So the banker, I told him, why are you writing the letters, he asked. I told him, look, he takes my money and then tells me a story. So then Bhakta called and told Shankar, kya karna hai? Settle karna hai. So he asked, what do you want? I told him I want 3 times my money. So then he said he'll call back. So he calls back and he says, no, that's not possible. We agree on twice the money. Then he says, I'll pay the money a month later. You stop writing the letters. I told no, I won't stop writing the letters. But I told Bhakta, if you give me a guarantee, oral, that I'll get my money a month later, I will stop. So he told, give me some time. So he called the other lawyer, Gagarat was the lawyer. He told, yes, I'll give you my verbal guarantee. And it got settled. And we were the last people who got money. The other investors who invested with me didn't get the money back.
Okay, only 3 more questions, 1 from me and 2 from the audience. The question is to
add one point here. I think we end up glorifying 1 or 2 bad cases a lot more. My experience is that 8 or 9 out of 10 cases, relationship with the entrepreneur or promoter is absolutely fine and fully aligned. And I'm assuming so would be the case with most other funds that I talk to. It's just that 1 or 2 cases out of 10, 12 cases where you have these issues. But otherwise, by and large, I think the relationship and the alignment with promoters is absolutely fine.
Okay. So you're saying promoters will love you. Okay. Ganesh, do you think venture capitalists and private equity can really add value in creating value in your company or any company?
No, I think
serious question.
No, So I think the first thing is if they don't detract the value, that itself is a major achievement. Okay, right? So that is very clear. No, I'm being honest. Okay, because I don't want all the audience to gather the impression just because there are more investors on this table and you talk about siphoning of money and this and that and court and litigation. That's really not the story. I mean, like Sanjay rightly said, it's 1 out of 10. Unfortunately, we have spent 90% of the time talking about that. That's not really true. Okay, right? They're all these people are here. Investors are here. They raise one fund after another fund because you and me as entrepreneurs give them great exits. Okay, right? People talk about exits. Okay, right? And that's because of the entrepreneur it happens. It doesn't happen because of the 2 and 20% that they take. So please don't carry the wrong impression. While that is true, that's only 10% of the cases. In terms of value addition, I think definitely they can add value. If you choose the investor right, what I mean by that is for every business, depending on the business model, depending on what are the key factors required to succeed in that business, the investors can definitely add value. There are obviously investors who have operated companies like Shankar. Manish is a great example. If you were doing a consumer internet company, who better than Bazi, founder, promoter, to be there as an investor, as against, say, an institutional bank being an investor. He can add great amount of value because he has got the network, he has connect, he has been there, done it before. The answer is categorically yes. I will stick to only VC. PE really I don't know because you are at a growth stage, at a later stage, more predictable. You are taking money more for money. At an early stage, 100% yes. Like I said, 8 out of 9 investors have had. I would say all of them categorically added value at different stages. And perhaps the biggest value was not detracting from the.
Okay, on that happy note, 2 questions from the audience.
Hi, I'm Yogesh. I run a company called Swearensoft. It's an IT company. And the question is that I've heard entrepreneur is a very emotional man, putting all his sweat and everything into the game. And this emotion is something when I started, I was like really I thought VC is the right way. I heard that a lot of people go. I went to a lot of VCs. They say, who are you? Nowhere. Just go away. And then I went to bank. Bank said, okay, fine, take some money. And then I raised at 12% and then I started. The point is that it was a fear cycle, but it was a passion where I said that I want to drive my company. It went well. Then I thought of that we have to scale up, need more money, and need more responsible people. I said, let me add my wife into the business. And that is another round where I started. And then again, the need of the fund was there. But at the end, when I say that I went and the entire journey was there, finally I got my term sheet in front of me. And I said, oh, wow, this is the day when, I've met 100 VCs and 1 term sheet is in front of me. That was the day when I said, oh God, this is a long list of tag and drag and, a lot of things. That was the day when I was already doing good business. And I said, I cannot move ahead because this is something which is difficult for me to understand. This emotional value and the passion and the sweat that I've put in is actually not matching the value of this lengthy contract. And I've not been taught, and most of the entrepreneurs are not being taught. And I thought that after making this deal, I will actually lose my actual integrity and dignity of driving this as a promoter. I would like to understand, what am I correct or wrong? Maybe a lot of people can, it's a small story and my vision.
Yeah, will one of you answer the question?
See, there's nothing right or
Yeah, can I have the mic?
See, there's nothing right or wrong in this. You have to see by doing that whether you'll be better off a year from now, 5 years from now. See, it is like before you get married, you have heard a lot of horror stories and then you say, oh, I'll never get married. So if you choose the right person as your wife, you'll have a good life. You choose the wrong person, so it eventually boils down to who the partner is. Like Ganesh rightly said, if he becomes a pest in your life, it is a problem. But if he is supportive, he adds values. We genuinely believe, for example, in the milk company, that if we hadn't invested, that company would never have got sold. And the 5 promoters agree to it. So that is the key.
Yeah, so just one, in the interest of time. No, I think I sympathize with you. First time when I went through all the clauses, the same thing came to me and all of that stuff. You will have this first time. Don't worry about it. Like I think Manish mentioned, 99% of the time nobody looks at that particular contract. Okay, right? If you are going to look at those contract in that 1% or 2%, anyway you are screwed. Okay, right? Then you're gone. Okay, right? It's been that. So go ahead and do it. Don't worry. Those contract, only lawyers make money. All the clauses will be there. Don't worry. That's not going to affect you. You should go ahead and do it. But you need to decide, can you give them exit? Will you be able to handle them as a partner or as a spouse? Or you want the full independence to run a lifestyle company? In which case, don't get married.
Okay, Arun.
Hello.
Who's the question to and what's the question?
Yes. Good morning. First of all, great insights by everybody, at the stage. My question is to Manish, but before I ask him the question, Manish, congratulations for your fund which you raised in such difficult times. But, in your talk today, you mentioned that you are going to focus on control investments. In a country such as ours, how do you see the deal flow prospects for control investing?
I'll take that quickly. Let me just tell you, I think if you look at a pipeline, it's actually, the quick answer is far better than we expected. Our initial, just to be a 1-minute clarification, our initial target was only to look at the non-core businesses of large family-owned businesses, which there are 100 examples of promoters and are willing to cede control to us. And we've seen that has been exactly where we expected it to be. What has been a very good surprise for us has been a number of things which are far more real today in our pipeline, which are first or second generation entrepreneurs who are willing to give controlling stakes in our businesses. A bit of this is not very difficult. I'll give you a classic example. It's a 68-year-old promoter, has a large business in South India. The 2 kids are like Avnish.com guys. They don't believe in brick and mortar and the good old industrials. They don't want to be part of the business. This 68-year-old guy, and there are many like him, by doing a deal with someone like us, could be anyone else too, has 3 things. One, they have the trust fund built immediately. But the thing we do differently is we actually say we don't want 100 in this case. We would much rather do a 2-tier process where initially we take between 50 and 80, more than 50, just to make sure there's no governance issue. And we would like, if the guy is honorable, and I agree completely with Ganesh, in 25 to 27 times that we saw they were honorable, we would like them to stay on as non-executive chairman. So the entrepreneur gets his day in the sun, he gets the ego, there's the pride, and frankly for us, we would much rather keep his name and brand because of many of the employees that he's hired and many of the customer relationships that he's developed over 15 years, it'll be impractical to get him out. So actually, in short, the answer for you in this one has been, we've been positively surprised by how many opportunities, and not just quantum,